Wall Street is throwing a hissy fit if the Fed doesn't do exactly what it wants, and you could end up paying. Market Watch's Sital Patel joins us now to explain. Sital, thanks for being here.
Thanks for having me.
You've written a column on this based on some facts that came out of the FT. How could I end up paying if the Fed doesn't do what the banks want?
Well, let me explain it to you. The Fed in their October minutes revealed that they're discussing reducing this 0.25 basis points interest rate.
That's a quarter of a percentage point interest rate that they pay the banks.
They pay the banks when the banks give their cash overnight or on a long-term basis to the Fed to keep the money, to keep the cash there. So they've been paying the banks this just for the last several years. It's unprecedented, hasn't happened in a very long time. And what the Fed is contemplating is cutting that interest rate.
And if that rate's cut, the banks don't get that money. So how do I end up paying them?
And that's it sounds like a small interest rate, but it's on $2.3 trillion. So it makes a difference for these banks. So that's why they're upset. And what they're suggesting is they're going to pass it on to the consumer. So to you and I.
To you and I. And the consumers are also the taxpayers, and the taxpayers were the people that bailed out Wall Street when Wall Street got into difficulty. Doesn't that seem like a thank you? Isn't that like sticking the fingers in your eyes of the people who saved you? I mean, the optics of this just look really, really, really bad.
Absolutely. You could definitely make that connection where they're, kind of flying in the face of, everything that's just happened in the last few years, and the banks, as you point out. But from the bank's point of view, they're losing revenue streams, and this is one of them, and they've been hit already when it comes to the consumer.
So if that happens to me, if I'm going to be charged to hold my money with a bank, I'm going to be down there saying no thanks, right? I mean, it's not right, and I'm sure you are too.
Well, there's like two ways. I talked to a few people yesterday, and they said, the likelihood of people taking their money out of their bank accounts is very slim, because you're not really earning a lot on your current savings account in the first place.
Yeah, but the optics of actually having to pay for it, right, is just even worse, right?
Absolutely.
So there's a difference between not getting anything, and then being sent a bill,
and your savings balance being whittled away by essentially a tax.
So, that seems crazy. Now, one of the things that the banks could do with all these excess reserves is they could lend it out. That was part of the quid pro quo when they took the money from the government, from the Treasury, i.e. from the taxpayers, was that we'll keep you alive, but you've got to lend. And, all these excess reserves, and the great chart in your column here, those excess reserves are not doing anything. They don't need them there for deposits. They could lend it. Radical idea.
Yes, and that is the Fed's point. They're looking for a stimulus. They're trying to incentivize banks to actually go out, deploy these funds into the marketplace, and help the economy. And that's what they're hoping they'll do.
Let's hope we don't get stiffed by the banks. Thank you very much, Sital Patel.